Kevin, it's always good to talk with you. And as we head toward the end of the year, I'm seeing all kinds of predictions about next year. But let's keep it simple for now. What do you see from this point, roughly the middle of December, till December 31st, when we talk about the markets and the S&P 500?
Sure. And who would have thought that on today, we'd see the S&P 500 up nearly 17.5%. Thinking back to April, if you recall, year to date through April the 8th, the S&P 500 was down roughly 15% following the tariffs tantrum. However, that tantrum was very short-lived, and we've seen the market move significantly higher since that point in time, which should serve as a reminder to all the investors watching this podcast of the dangers of trying to time the market, because oftentimes retail investors flee the market or rush to the sideline when volatility picks up, and they tend to miss out on the most significant returns the stock market has to offer because they wait too long to get back into the markets. But from now until the end of the year, I do see a potential for even more upside. Not significant upside, but perhaps a little sprinkling of a Santa Claus rally, if you will. And that's likely to come from some of the retail investors or even some of the fund managers that haven't enjoyed all of the returns that have really been focused around this AI and AI infrastructure trade year to date.
All right, but let me ask you, when we talk about upside for the rest of the year, and I realize we're up, as you pointed out, it's been a spectacular year for the S&P 500, but there's so much criticism that this has all been driven by AI and the Mag 7, the Mag 8, and that bubble is now deflating. What do you say to the critics who would say what I just repeated?
Sure. I would say the potential for an AI bubble and the potential for a Mag 7 bubble are two very different things. So the Mag 7, let's look at their returns. Going back to 2023, the Mag 7 accounted for 62% of the total return of the S&P 500. Last year, it accounted for 54%. As we look right now in 2025, it accounts for about 44%. So yes, still leading the way, but they're now starting to take a back seat to other areas of the market. And that's very healthy for the sustainability of this now 3-year-old bull market run. In terms of the AI bubble, I think we're still in the very, very beginning stages. Last time we were on together, I used a baseball analogy with you, Adam, and I suggest that we're just in batting practice of a doubleheader. We're still there because batting practice involves all of this AI infrastructure spend that Jensen Huang suggested could total somewhere between 3 to 4 trillion by the end of this decade. So there's more spending on the way, and that creates the opportunities in the industrial sectors, the construction companies, the electrical companies, the cooling solutions, and of course the power solutions, whether they be natural gas or even nuclear. So I still see investment opportunities in that area, but I do think that that technology trade, the AI bubble, is going to continue to be questioned throughout 2026, and that will create more short-term bouts of volatility along the way.
So let's talk about 2026. I saw one analyst from a large institution, and I always take this with a grain of salt.
Yes.
That analyst was saying that we will see S&P 7,600 at the end of 2026. What I don't know if you put out calls like that, but when you hear pontifications like that, what do you think?
Yeah, unfortunately, I don't have a crystal ball. At least I didn't bring it with me today. But what I do feel conviction in is that the market should continue to move higher in 2026, albeit with much more volatility than we experienced in 2025. We have to remember, as we turn the page into 2026, it's a midterm election year. We also know that temporary funding bill of the government expires at the end of January. At the end of the year, we have more debt ceiling debate talk again. We still don't know the resolution and the status of the tariffs and if that money will ultimately need to be returned, and how does it get returned, and who does it get returned to? And of course, a new chair of the Federal Reserve coming in May. That's a lot of potential question marks for investors to deal and grapple with. But I am comforted with the notion that looking back on the last 50 years, the last 5 times the bull market has passed its 3-year anniversary, as it did in October, it's continued to move higher by an average total duration of 8 years, which would suggest there's 5 more years to go. And if you're going to ask the question, as I know you do, you're a very astute interviewer, Adam, what's the shortest total duration? It was 5 years, which would suggest we have 2 more years to go. So maybe this time will be different, but I'm confident in that type of historical precedent. But I don't think the areas that led the markets during these first 3 years of the bull market are necessarily going to be the areas that lead the next 2, 3, 5 years of this bull market. And that's encouraging for investors to consider to broaden out and diversify their portfolios.
So help me understand, and I'm not going to say the individual's name. You know him well because you were both guests when I was doing the Yahoo thing. This individual's moved on to a different firm, but put out a note recently just saying that the annualized return for the S&P 500, the metrics are setting up that the next 10 years will be essentially zero growth in the annualized return. Now, that doesn't include the fact you're still going to get dividends and all of that.
Sure.
But from a valuation perspective, wouldn't that be troubling? And what am I missing when I hear that analyst say that?
We could have another potential lost decade, this particular analyst is saying. I don't know if I necessarily subscribe to that notion, but most investors don't just invest in the stock market. They don't just place all of their hard-earned money into the S&P 500, but rather they tactically adjust throughout the course of any given year into different sectors, into different geographies, and different asset classes. And that type of forecast, if it proves true, suggests to me that investors are now going to have to be a lot more selective moving forward to find these attractive pockets of both growth and income opportunities. And to find those, I believe, Adam, you need to follow the money. Follow where all of the committed levels of spending are anticipated to take place over the course of the remainder of this decade. AI infrastructure, aerospace and defense, power, including nuclear power or even small modular reactor power that allows data centers to get nuclear power off grid. Fascinating. We're in the very nascent stages of that. How about small cap biotech M&A? We've seen a resurgence in healthcare sector performance of late. I believe a lot of that is driven to the potential acquisition momentum that's taking place with respect to biotech. So there are opportunities for growth, but you can't just throw a dartboard going forward at the S&P 500 dartboard and assume you're going to get an attractive return, as you could argue you did in 2025, albeit to different extents.
Before we get into some specifics, though, at the beginning of our discussion, what you were pointing out is that, look, if history is an indicator, it's not a guarantee.
Yes.
But an indicator, the next 5 years look very good for the S&P 500, is what you were saying.
Yeah, at least in terms of the continuation of this bull market run. So I would suggest for investors who are optimistic about the future, if they believe that inflation is now continuing to moderate, as the Federal Reserve suggested last week, if they believe that the economy is going to grow, albeit at a modest pace, as the Federal Reserve told us last week, if they think that unemployment might rise to 4.5%, but then come down a little bit to 4.4% in the following year, as the Federal Reserve suggested last year, well, that's a pretty ripe environment, not just for economic growth, but also for stock market growth. But there's going to be certain areas of that stock market which, again, aren't overvalued, are going to see more spending coming their way, and are going to offer more growth opportunities.
Let's talk about the things that no one can ever have a crystal ball. You forgot to bring yours to this discussion.
I apologize.
We still have, between now as we're talking and the end of the year, we could have a decision on the tariff situation from the Supreme Court. That could throw a monkey wrench into things or not. I mean, how as an investor what Pepto-Bismol can I grab to calm my nerves?
Yeah, I think the biggest question marks for the remainder of 2025 were answered last week, and they came from the Federal Reserve, as there was still some debate heading into that meeting if, in fact, they were going to cut again, the third time of 2025 with their 25 basis point cut. So from this to the end of the year, I don't think there's going to be any significant news announcements. Now, I know we've had a backlog of economic data that wasn't released due to the government being shut down, and we'll start to get updates on retail sales, on CPI over the course of the next couple of weeks. But really, investors think about that data in the context of what the Federal Reserve may do with that in terms of monetary policy. They don't meet again until the end of January. So if it creates any short-term bouts of volatility, any of these economic data releases, I think money will come off the sidelines and go into those areas of the market that have led the returns thus far this year and give us a little bit of a Santa Claus rally to end the year.
I always, different guests, I always forget if you're allowed to talk about some of the stocks that you like specifically. If you are, please share with us what you're looking at in 2026.
Sure. One stock that I would talk about that we do own within various portfolios at Smart Trust is Comfort System. The ticker symbol is FIX. You can find them in the industrial sector. Now, you may question, why are you so hot about an HVAC company in the industrial sector? Pun intended. Because what Comfort System does is supply cooling solutions to data centers that tend to run very hot. Now, they're also going to be included in the S&P 500 as of December 22nd. Their stock's over 100% year to date. And over the last 5 years on an annualized basis, they're up roughly 82%. That's pretty impressive for an HVAC company. But it reminds me as a portfolio manager to look for other ancillary benefactors of the AI revolution. Comfort System doesn't have a monopoly as it relates to cooling solutions. You can look to other companies such as Vertiv, ticker symbol VRT, Modine Manufacturing, ticker symbol MOD. And that's just one segment within the ecosystem. You can then look beyond into the data centers, the data center construction companies, the software suppliers, the hardware manufacturers incorporating AI into what they do. There's a tremendous amount of investment opportunity still ahead, but some of them are trading very rich right now, so investors should take valuation into consideration before making any investment decision.
I'm going to kind of put you on the spot. Are you personally, are you keeping more cash to the side than you would normally, or are you fully deployed given your personal history? I'm not asking the numbers, but just your where you are right now.
Generally, I remain fully invested, consistent with my risk tolerance, what my longer-term investment time frame is, and my own goals and objectives, with a balance between bonds and also actively managed diversified growth portfolios.
And as we start to wind up, I do want to ask you about a theme you see in a lot of people's essays on finance and investing, which is the K-shaped economy. That those at the higher end are doing very well in spending money. Those in the middle class to the lower end are not. What do you say about the threat that poses, if it's a threat? I don't want to put words into anyone's mouth for 2026.
Yeah, I view that as being a significant threat because the affordability crisis is real. And you and I can talk about all of the economic data results, the forecast coming from the Federal Reserve, but there's still a large part of America that feels America's too unaffordable right now, and they're struggling. So will lower interest rates help them? It might. But if we're talking about short-term interest rate, that impacts the Fed funds target rate and doesn't necessarily have an immediate impact on what interest rates matter to them much. Credit card bills, their car loans, their student loans, or even mortgages as a whole. As we look inside of housing costs certainly need to come down. And as I understand it, some of those shelter costs should be coming down in 2026. And that could be a benefit to those people at the lower end of the K, because the upper end of the K has done very well looking at the returns of the stock market in 2025. So I think the problem is real. I think it needs to be addressed. And I think it's going to be at the top of many voters' mindsets as we head into the midterms in 2026.
I have to apologize. The banging you hear is the 100-year-old heating system in our office building. The steam is coming up the pipe. So if you hear banging right now, that's
sounds like you need some cooling solutions.
Not yet. Not till summer. What surprised you most about 2025?
Boy, what surprised me the most is how much I would say that the AI revolution came into question. How it seemed as though certain investors, or perhaps certain segments of the financial media, not yours included, were kind of rooting on for an AI bubble to burst. And I started to question, why are they rooting for this AI bubble to burst if you really look behind the numbers and see how early we are in the ultimate adoption of AI? I think, Adam, there's AI revolution is going to be a very long and winding road filled with many potholes. And there will likely be, as there have been in previous industrial revolutions, more losers than there will be winners. But I think the losers are going to be marked by those that either overspend or, perhaps even more so, underspend. So those companies that aren't devoting resources to AI now are likely to be left behind or left scrambling down the road, and that's not a good business proposition. So is it right to question any run-up in the market? Certainly. You should always look at valuations, but it just seems as though there's a certain element that continues to poke at and hoping they're going to burst this AI bubble. And I think if they're waiting for that bubble to burst, they're likely to be waiting for quite some time and miss out on quite some returns while they're waiting.
2026.
Yes.
When we have this discussion in December of 2026, what do you think will be the surprise no one expected?
What will be the surprise of 2026? I believe that perhaps inflation may not come down as much as some are currently forecasting. I believe that the economy may not grow by as much as some are currently forecasting. And the current one rate cut that is forecasted by the Federal Reserve may need to be more than one rate cut. And for those out there that are forecasting rate increases towards the second half of 2026, I don't think there's a high probability of that right now. I think there's more of a probability that we might get 2 rate cuts in 2026 as opposed to 1 or more rate increases.